Hey, what's up everyone? Welcome back to FX Limit, the ultimate spot for all you need to know about Forex trading. Today, we've got a real treat for you, especially if you're looking to up your trading game and make some smart moves in the market. We're diving deep into the world of economic indicators. Now, if you're trading Forex, you've got to know that these indicators are like the secret sauce, the magic ingredients that give you a glimpse into a country's economic health. And understanding them? Well, that's what can set you apart in this game. First on our list is the heavyweight champ of economic indicators, the gross domestic product, or GDP. This is the big picture, the total value of everything produced by a country. It's like taking the economic temperature of a country. When GDP is up and climbing, it's a sign that things are on the up and up, and that usually means a stronger currency. But when it's down, it could be a warning sign of tougher times ahead, and that can mean a weaker currency. So keep your eyes peeled for those GDP reports. They can really move the market, and you want to be ready. Next, we've got the Consumer Price Index, or CPI. This one's all about inflation, showing us how prices are changing over time. If inflation is high, a country's central bank might hike up interest rates to cool things down, and that can lead to a stronger currency. But if inflation's too low, they might drop those rates to give things a boost, and that can lead to a weaker currency. So for us Forex traders, CPI is a must-watch to get a sense of where interest rates and the currency might be headed. Now, let's talk about the unemployment rate. This one's pretty straightforward. It tells us what percentage of the workforce is out of a job. A rising unemployment rate can be a red flag, signaling a slowing economy, and that could mean a weaker currency. On the flip side, if more people are finding jobs and the unemployment rate is falling, that's usually a good sign for the economy and the currency. So keep an eye on those employment reports. They can give you some valuable clues about the economic landscape. All right, moving on to the central bank interest rate decisions. These are big, folks. When a central bank raises interest rates, it can attract foreign capital, pushing up the currency. But when it lowers rates, that can lead to capital flight and a weaker currency. These decisions are huge drivers in the Forex market, so you definitely want to mark your calendar for these announcements and be ready for some action. Don't forget about the balance of trade. This one measures the difference between a country's exports and imports. A surplus, where exports exceed imports, can be a bullish sign for the currency, as it means there's high demand for the country's goods. A deficit, on the other hand, could be bearish, as it might indicate weaker demand. So, tracking the balance of trade can give you some great insights into currency movements. Next up, the Purchasing Managers Index, or PMI. This index gives us a snapshot of the manufacturing and services sectors. A PMI above 50 signals expansion, while below 50 signals contraction. For us traders, a rising PMI can be a sign that the economy is humming along, which can be great for the currency. But a falling PMI? That could be a warning sign of economic trouble ahead. So keep an eye on the PMI. It's a great leading indicator. Consumer Confidence Index is another key indicator. This one measures how optimistic consumers are about the economy. High confidence can lead to increased spending and economic growth, which can be great for the currency. But if confidence is low, spending might drop, and that can hurt the economy and the currency. So, tracking consumer confidence can really give you an edge in understanding potential market movements. And lastly, don't forget to utilize the economic calendar. It's not an indicator per se, but it lists all the upcoming economic events and indicator releases, helping you stay on top of your game and prepare for market volatility. So, there you have it, folks. These are the key economic indicators you need to watch when trading Forex. Understanding these indicators can provide you with valuable insights, helping you make smarter, more informed trading decisions. Keep learning, stay sharp, and happy trading.